Hello everybody! In this video I want to walk you through a gold trading framework that I personally like because it's structured, logical, and not based on guessing where the price might go next. It's built around three main ideas: understanding value in a price range, waiting for a structural shift in a lower time frame, and entering on a controlled retracement instead of just chasing momentum. I'll explain what I mean by discount and premium price, what the change of character actually represents, how Fibonacci retracement fit into the picture, and why the alignment between the structure and Fibonacci creates what we call a confluence. So by the end of the video, you should not only understand the steps, but also the reasoning behind them. So let's start with the higher time frame because that's where the main understanding will come from. Okay, so we're starting with part 1, understanding the range and value. So when I open a gold chart, I don't immediately look for an entry. The first thing I try to understand is, where are we inside the current range? So the current range is basically just a large impulse on a higher time frame. So it would be basically just some large move like this. Of course, if we were to look at it in the lower time frame, then we would probably see smaller moves building a bullish trend. But all in all, we don't care about that at this moment. We just care about this total price range. So let's just say that the price range from here to here is from $4,500 to $4,800. Okay, so now that I know where my price range is, I try to identify where I am in this current price range. The first step is to identify the meaningful swing highs and swing lows. So that would be the highest and the lowest point of this range. So here would be our swing high, and here would be our swing low. I identify this swing high on the 4-hour time frame or 1-hour time frame. So now, instead of looking at every single candle inside this range, we focus on the entire move as one unit. Now, if we divide this range into two halves, we get a midpoint at 50%. So this here would be the midpoint. Below this midpoint, price is relatively cheap compared to where it recently traded. Anything above this midpoint would be more expensive. That's what we call the discount and the premium price. So anything in this area here would be a discount price, and anything on top would be a premium price. Okay, let's say that price is moving in the discount price. For example, let's say that we're somewhere here. This doesn't just mean that just because price already entered some discount area that we just buy blindly. It also doesn't mean that price has to go up onto the premium price immediately. It just means that relative to the defined range, buyers would be entering at a more favorable price. When price trades in the upper half of the range, that's premium. And again, it doesn't guarantee any reversal, but it tells us that if we are looking for shorts, we prefer sell from an expensive area rather than from somewhere here in the middle. So the higher up we go, the better our risk to reward would be if the price actually pushes toward our anticipated direction. One very important thing here is patience. Being in discount does not mean we blindly buy, and it only means that we are in an area where buying makes sense if we get confirmation. So the higher time frame gives us a location. It does not give us timing. Once price reaches discount on the higher time frame, that's when I shift my attention to a lower time frame for confirmation. So higher time frame is for location and lower time frame is confirmation, which now brings us to the second part, understanding the change of character. So lower time frame for me would be the 5-minute chart or 15-minute chart. Now I'm not looking for value anymore. I am looking for some clean structure. So I'm not looking to understand in which range we are or in which area we are, but rather how the structure looks like specifically. So let's just imagine we have a trend going into the discount price, and now we're located in the discount price zone. As we can see here, markets move in sequence. So this one would be a bearish trend. The price is going down. So we have lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. This is our structure. In a bullish phase, it would look completely the opposite. So we would instead have higher highs, higher lows, higher highs, higher lows, and so on. Now, where in this chart do we have our change of character? It's important to understand from which character we're shifting from. So here we can see that we had a bearish trend, which means that the price was going down. So the change of character would be the price starting to go bullish, so starting to go up. The exact point where we have our change of character would be that point where our structure shifts. So we see here that we have a lower high and a lower low. So the natural continuation of the trend would be another lower high and then another lower low. But as we can see here, this lower high right here was broken by this move. So now this point shifted from being a lower low to being a higher low. So now we have a higher low, a higher high, a higher low, a higher high, a higher low, and so on. So as we can see, price has now changed its character and we now have a bullish trend. So it suggests that the flow of orders may have shifted from sellers dominating to buyers stepping in more aggressively. What I like about this concept is that it forces you to react instead of predict. So instead of saying, I think gold will reverse because it's in a discount zone, you wait until price actually proves that buyers are strong enough to break structure, to change character. So a change of character is also called a break of structure. That's a big psychological difference. So you're not trying to be right early on, you're just waiting to see the evidence. And after a bullish change of character, we often see a strong move upward. And that move is what we call the impulse. It happens because once structure breaks, several things actually occur at once. So short positions may get stopped out, breakout traders may enter long, and momentum traders jump in as well. However, markets do not move in straight lines forever. So after this one stronger impulse, we of course have our pullback. And this pullback is also what we call a correction. This is where Fibonacci comes into play. So here I would start taking out my Fibonacci tool from point A to point B. So let me zoom in a little bit here. Okay, so here are my Fibonacci levels. The important zones for me would be the 50% zone, so the 0.5, the 61.8, and so on. The 61.8 is often called the golden ratio. You don't need to treat it as something mystical. In practical terms, it simply represents a deeper retracement that still maintains the integrity of the impulse. So if price retraces around 50% to 61.8% and then continues upward, it suggests that the pullback was a correction and not a full reversal. In this strategy, I am particularly interested in the 0.618 retracement of the change of character impulse. I don't enter during the impulse itself because that usually means low risk to reward. So instead, I just wait for the correction to bring price back into a more balanced area, which now brings us to the fourth point, confluence. So the 618 level alone is not enough, and this part is important because I'm not taking every 0.618 retracement I see. What makes this setup stronger is confluence. Confluence means multiple technical reasons that align at the same price area. So in a bullish scenario, here is what I want to see. So first, on a higher time frame, we have our range and price is in a discount area. The second thing I want to see on a lower time frame, so either M5 or M15, we get some bullish change of character like we had here in this impulse, which broke the structure from the previous trend. Number 4 is we draw the Fibonacci from the impulse low to the impulse high. And the key part is when price retraces to the 0.618 level, I want that area to align with some previous lower high or lower low that was broken during the change of character. So in this case, I didn't draw it perfectly. It would actually mean that this impulse would have been way stronger here, maybe, and this retracement would have actually been somewhere around here, so around the last lower high. So here in this scenario, this pullback is actually not aligned with the lower high. So it's not a 10 out of 10 setup. It's still valid, of course, but I'm going to show you what I want to see on the actual gold charts. Okay, so let's look at the actual gold chart. Currently, I'm on the 4-hour time frame, and I am looking here at some range. So one range I would pick out for myself would be this one, this impulse starting from here up until up here. So I'm just going to pull this a little bit longer. So you see anything that is above this middle line would be the premium price where I would look for shorts, and anything below it would be a discount price where I would look for longs. Okay, so now that we know that price is in the premium area, we go into the M15 or M5 to look for our confirmation and break of structure. Okay, so if we were to roughly eyeball it, we would actually see that the price here is bullish. Because if we would zoom further down in M5 or M1, we would actually see some clear structures with higher lows and higher highs. So we can see that here, price actually reached a little bit more than the maximum of the actual premium area. So if I were to follow the candles and draw a trend, we can start here, a higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, low, and let's just make this our last higher high. So actually here we can see that this was our last low. So if price were to break below this area, we would have a change of character. So now we can actually see that price broke this last higher low, and now we have our expected change of character. Okay, the question is, what do we do now? Now that we have our main impulse, which gave us our change of character, we take our Fibonacci tool from the last high to the current low. Okay, what we want to do is we want to put our entry preferably at the 0.618 level. So we would enter a short position on the 0.618 level. We would put our stop loss at the last high, and we would put our first target at the last low. So this one would be at least a 1.6 risk to reward. And if we see further down the line, it actually hit the first take profit, and it would have potentially given us a 1 to 5 risk to reward, depending on how long you hold the trade. Because you actually have the higher time frame confirmation, you can actually hold the trades quite long, so they don't have to be intraday, because in this example, we actually bought at the highest premium point, and if price starts moving into our direction, we could actually hold it up until the next resistance or support, which would have been here at a almost 1 to 4 risk to reward. So with this strategy, I aim at a 1 to 1 or 1 to 2 risk to reward on gold that is often very achievable because of its high volatility. And the idea here is consistency and not hero trades, so nothing that will make you rich in a day. One thing I like about this strategy is that it forces you to slow down. You have to think in terms of price value first, then look at the structure, wait for your confirmations, use your retracement tool and enter your position, which usually isn't quite a quick scalp, especially if you look for entries in the M15. If you were to look for entries in the 5-minute time frame, then the trades would probably be moving faster. I like the strategy because it prevents you from chasing candles in the middle of nowhere, and you actually start asking different questions. So, are we in discount or premium? Has structure actually shifted? Is this a correction into a logical support area? So instead of just reacting emotionally to every move, you wait for alignment. Okay, so to wrap it up, you look for your higher time frame range, you identify your discount and premium zone, you look at where you're at in the price range right now, and then you go into the lower time frame, M15 or M5. There you wait for a structural shift, take out your Fib tool, and look for the 0.618 correction of that first impulse. The stop loss you put at the last high or low, depending on whether the trend is bullish or bearish, and then you target at least a 1 to 1, but most of the time a 1 to 2 risk to reward. And that's it. So thank you for watching. I hope that you will be trying this strategy out and hopefully make some good profits with it. But always remember to keep your risk management in check and stay consistent with the strategy. Until next time.
holaprime, trade with transparency.